go. First stream, baby.
Live.
Feels good. It's been a long time coming. I mean, obviously, I was talking to somebody today. I've been doing Millionaire Mindcast for 12 years.
I've been doing it with you for 7. 6.
Yeah,
7? No, August 19, right? Yeah. 7 years.
So, obviously, this show has been a total passion, labor of love. I do it, one, because I get to do it with one of my best friends. I do it because I get to connect with so many amazing people from all over the world. And it forces me to keep all the tools in my, toolkit sharp and engaged. I actually have a true passion for wanting to become a better investor, wanting to build wealth. I love these conversations. I learn something from you on every, show. I learn something from the people that reach out to us. There's just so many cool things that come from this. So we figured one of the best ways to connect with more of our listeners is to do the live streams. I mean, live streaming obviously has been something that, you look at some of the biggest creators in the world now, they're getting followed around with cameras. I mean, they got more clout, more pull, and they're building wealth faster. And they're changing the way society and trends. And the influencer space is really just going to a whole nother level. And I think a big part of that is streaming in real life stream.
Yeah, IRLs. I haven't got behind them yet, but I know the big names like Speed and some of the Neon, and I know Mr. Beast is pretty big in that space. But I can't even imagine it would be like you just get followed around 24/7. Yeah, not 24/7, but for the majority of your working days, you're just like, this is what I'm doing.
There is a part of that, right? That part of me loves to move in silence and to not have people all up in my shit, knowing everything about me. I think there's a lot of people do overshare, and in some ways it's kind of cringe.
Yep.
And then at the other side of it, there's massive value in it. And I think the people, you look at some of the most authentic streamers and creators, you don't have to be controversial. Everybody's got their brand. So if your brand is being controversial and saying shit that you think, is going to get more likes, views, clicks, rage bait, whatever it is, hey, do your thing. I'm not here to judge. And at the same time, I also know that there's another side of that coin too, that there's some people that just genuinely are being themselves. They're authentic, they're helping, they're bringing value, and they're getting rewarded handsomely for it as well. I even saw it today. So check this out. I met Cody Sanchez. Gosh, it was 2015, something like that. And she was just kind of coming onto the scene. Tony, you can pull this up, but going back to creators that are making dough. Big shout out to Cody first and foremost. $31 million in estimated earnings from 2025 of March, 2026 of March, with only 10 million followers. She's got the least amount of followers out of all these people. And she is somebody that I think is trying to help people buy businesses, that is out doing amazing work. Even a lot of these creators I think are doing, really cool work. Drewski always has me fucking laughing my ass off.
He's hella
it's not just dancing and, doing the silly stuff. It's people bringing real value. Stephen Bartlett and, Diary of a CEO, just really cool stuff. So I just thought, this whole, I'm very... Well, we're going to get to a bullish and bearish segment. I got a special segment for you today that I drummed up. That we're going to get Ryan's take, and we'll kind of share just our thoughts on whether it's stocks, it's industries, it's ideas or strategies, and whether you're bullish or bearish on them. IRL is on that, because I think in the world of being so disconnected, I think the pendulum swung so far in terms of digital, social, everything, that the craving for real IRL experiences, interpersonal connections, the face-to-face, that really has a newfound appreciation and ROI that I think people are coming back to in a really big way. So we'll talk on that. But I think number one, of course, I like to talk on Money Moves about all things stocks, real estate, crypto, and social trends. We like to sprinkle in a little bit of politics, because at the end of the day, policy impacts what we're doing. We are live, so if you guys do want to drop questions, comments in, let us know your thoughts, give us your feedback. we have, first and foremost, I think the biggest thing that moved the markets last week, that was everything we've been talking about for the last few months, was Powell on his way out.
Yep.
And that whole Fed regime kind of coming to a close. We know how Trump felt about, too late Jerome Powell.
Yeah.
And we also knew who was coming in, which was an appointee that everybody believed was, put up by Trump for a very particular reason, that he was going to come in with a little bit of a dovish mindset and stance. And there's a lot to unpack from last week's FOMC. So I want to hear your take on it, because one, the market reacted, and then it reacted again after that. I think there's always like the initial reaction, and then there's kind of all right, let's flush that through the system, and like what's really, the outlook going forward. So here's the recap from Kevin Warsh's first FOMC speech. First and foremost, he said that I thought was interesting was that they're going to give far less information going forward.
Yeah.
So they're going to give, which the market got very used to Powell and his administration kind of giving a lot more insight and sentiment and the data.
Used to it.
A little too used to it, right?
Yep.
And that was something that we saw the market respond heavily from, up or down, depending on what that sentiment was. So Warsh said, hey, we're going to kind of keep things a little bit closer to the chest. During the press conference, he announced that the Fed has dropped its forward guidance. He even hinted that the dot plot could be changed or eliminated along all forms of Fed communication, such as the policy statement and press conferences. So in other words, right, the market will now have less Fed outlook, which means more uncertainty. We know the markets don't like uncertainty. And he also noted that they were creating 5 new task forces established by Warsh that were said to have grand objectives with minimal guidance on what to expect. So I don't know. To me, this is like a Fed that is going to be a little bit tighter lipped. It's going to create less clarity and direction for the markets. And is that a good or a bad thing from your perspective on how the market digests this? And just from that first speech, what did the market do, and how did things kind of play out over the course of the last week?
Yeah, so I think that would be the only dovish thing that we got from the meeting, and I'll touch back on that in a second. But the market had just become too ingrained in betting on the Fed cuts based on the speech. So we would watch, you'd watch Jerome Powell speak and then have the live moving market right next to it. And you'd see it go all the way up or all the way down.
Yep.
And I think the problem with that is that's all people were waiting for. And then they looked at the dot plot and they said, okay, now we're going to make our bets for the next 35, 45 days, depending on the length between the Fed meetings. And they were going to live and die by that sword. So to me, that doesn't create an efficient or open market like the Fed is supposed to. It's creating kind of a betting market based on what the Fed says. So what they did, I think, in the interim, or what Warsh did, is not only kind of put his mark on history for what did he do as Fed chair? Well, if anything, they're going to say he removed guidance out of the Fed, which is huge. That had not been done for a very long time.
Do you like that or not?
I do.
I think that's a good thing.
Yeah, I do think that is as weird as that is, and I wasn't expecting that. I've digested it as more of a dovish position, because instead of saying, hey, instead of the Fed chair being so, we're supposed to have this independence,
Right.
but Jerome Powell could just essentially influence the Fed and the board and say, no, we shouldn't cut rates, or yes, we should. We'll just be independent from that. We won't give guidance to the market. We'll truly let the market take us where it's going to take us, and we'll make rate cut decisions or hikes or pauses based on that. So, and then, we still don't know who the missing dot was. And I think that probably was Kevin Warsh. That was my indication, because that would line up with him not
being like, hey, we're not going to do dot plots.
Correct.
Potentially not do dot plots.
And I don't even think the Fed chairs knew that, because they all submitted theirs, obviously. So, will we see the end of dot plots? I don't know. I think that they'll be submitted by some and maybe not by all. But I think the disconnecting the Fed so much from being so important to how the market moves is a good thing, because it also does on the other side. Alan Greenspan is kind of the architect of the rate cut to save the market, and we're dealing with addictiveness to that. Essentially, it's been almost like a heroin to the market, because anytime there's a problem, they just say, "Oh, we have the infinite solution. We'll just cut rates. It'll inject infinite capital into the market." But then you have the issue of people meeting their debt obligations, good debt, bad debt, running up credit card debt, and some of that not being handled properly. So we're still dealing with the Greenspan era of 2008-ish today, and the issues from that almost 20 years later. I think it removes the reliance on rate cuts to keep the market stable as well, and makes people more independent of the Fed, and lets people get more used to, and what probably is going to be happening, higher interest rates, what people normally dealt with prior to 2008. Because the rate environment that we're in right now, I feel like the only reason people are complaining about it is because it hasn't been the norm for so long.
Yeah, we got spoiled over,
Yeah.
especially post-COVID. I mean, everybody just got addicted to cheap money.
Yep.
Prices were going through the roof.
Our parents got to take advantage of it versus us. And so that's the disadvantage of timing, because most of our generation is now getting into that buying window. And where can they purchase at? 5, 6, maybe buy your rate down to 4.5, but 5, 6, 6.5%. So their mortgage payment is double what mine would have been on the same home costs.
Yeah.
So with a home value, that's 40% higher.
Yeah, with where values are at. I mean, that's the average home, I think, in 21 markets that we saw last week was over $1 million. So you slap a 7% interest rate on that for the average young, millennial family that's not making, multiple six figures. It's hard to get your fair share of the American dream, right? So that's something that
franchises a lot of people from becoming homeowners, and then you get lifelong renters. And then where are they spending the additional money? Are they waiting to inherit the asset? What are they doing?
Yeah. Now, we saw kind of coming out of that meeting, rate hikes didn't seem like they were on the table, or they were maybe softly being floated out there, depending on really how this Iran conflict plays out. We'll kind of do a quick little update on that. Because that seemed to be something that really, and you and I were talking about this on X, the Iran conflict seems to be the linchpin of everything when it comes to whether or not the Fed can really drop rates, or if they hold them, or even if they hike them, because the Iran conflict seems to be the domino that is driving oil and energy prices. And you had mentioned something along the lines of, because Warsh had said, obviously we're paying attention to the Iran conflict. Inflation's on an uptick a little bit. Inflation is a choice, he said, which made me think that was kind of his stance of being like, hey, we're going to hold firm if we have to. We're not going to cut too early, because we want inflation to go away. And that is what the Fed is mandated to do, is to get back to that 2%. Now, we all know that getting to 2%, like when have they ever gotten to 2%?
Yeah, never. I also don't really get that mandate, because I feel like that mandate's just kind of a
little outdated.
Yeah, well, not outdated. It's like way too forward thinking. Plus, the sweet spot's always been around 3. So again, I don't. I've said that over the past couple of years. I think 2%. It's like, why are we at 2%? Pre-COVID, we weren't at 2%. So
Yeah,
why are we at 2% now? It doesn't really make a lot of sense.
Yeah, so he basically said, really the Iran conflict, which Powell had said too, is, hey, we're paying attention to oil and energy prices. We know energy drives damn near everything in what we do and how we use it and everything like that. And with the last print, inflation being up a little bit, solely being driven really by inflation, as quick as that inflation can kind of uptick because of the challenges with energy prices, you also made the point that it can easily come off and strip back down, right? If we can get the flows back to where they were at, We have seen energy prices spike and drop depending on what's going on. I mean, as of last week, I think was the most positive news we've seen come out of the Iran conflict, which was that 60-day MOU, which was signed by both parties, Trump in Trump fashion on Friday, when they're in Switzerland working on it collectively, both sides, the mediator in there, and then Trump goes and says something about bombing them again, and some Trump tweet, and they actually walked out of the meeting and were like pissed off about it. They suspended the negotiations. It seems like it's gotten back to a point where they're discussing and working through it. But at the end of the day, like, this is still no closer to anybody feeling that true confidence that this is 100% solidified. It seems like many of these false starts and stops and price of energy and crude oil has ping-ponged because of that, based on what, those tweets are, and that uncertainty kind of is, right?
Yep.
So do we think that the sole, and is your opinion that the sole ability of the Fed to cut and or raise rates is predicated on this conflict being 100% solidified? And do we even trust in what we're being told right now? Do we trust in Iran? Do we trust what's going on with our government, that the markets and the Fed can respond accordingly? Like, what do we actually need to see in order to feel confident that oil is going to come down and we're going to, be able to rely on that pricing going forward and hopefully see inflation, follow suit?
Well, it's nice to see that oil is trading back around $73 a barrel right now, which is a little bit, probably $8 or $9 a barrel higher than it was the pre-Iran conflict. But yeah, I do think that the one thing that the conflict has kind of in its palm or more control over is, if the conflict persists, the sentiment around will oil prices spike, will inflation be an issue, is going to be persistent. And so when my belief is that it's going to continue to trend towards a positive outcome, because they did sign the MOU, which I did think was a good idea. But something I read in the MOU that I want to point out, it's 60 days, right? There's implementation periods over that timeline, and it can be extended mutually upon agreement of both parties. And so I wouldn't be surprised if it did get extended.
I believe it will.
Yeah. And I just think Iran is in a position where they've lost, but they're trying to save face, and the United States is in a position where midterms are around the
We
corner.
want to get it done.
We want to get it done, but they know that we don't want to also increase conflict, because that's going to potentially spike our CPI, and that could hurt the stock market, which is not good going into midterms. So there's politics at play. There's geopolitical risk at play. There's all sorts of stuff at play that's not really fun or fair. But at the end of the day, I do agree that the Iran conflict is going to be sticky and be around for a few more months, but be cooling off over that period of time, finding commonalities and common ground and compromising over those periods of time. But I also think it's either going to accelerate or continuously push back. It's going to continuously push back the interest rate cuts, but it's probably going to accelerate the possibility of a rotation, because traders will start to say, okay, this rate cut is going to be farther back than I'm anticipating. Traders are typically putting out 6 to 8 months when they put equity purchases out. So what's going to happen in 6 to 8 months? And so that correction that I was talking about, although it's probably going to be short-lived or quick, that looks more and more likely. And it's nice when we fall in little chunks like this versus it being huge 4 or 5% days, because you have less freaking out. But I also think that that's going to, once we get to that correction point, whenever that is, either now or later, it's going to still give traders an opportunity, and it's going to recover quickly, because what they'll see is inflation data slowly going down, because the market will continue going down, and that gives Fed reason to pause, not raise. And that's kind of my whole thesis now. I know I'm going to be wrong on the cuts, even though I called it
Yeah, your July
Right, that
cut.
one into the dirt. But what
I was hoping you were going to be right.
I think everybody.
I wanted you to be right. I wanted to see, I wanted to see rates.
Cost of capital is still too. I mean, it is high. It's too high.
Yeah,
for people to use it how they need to use it. I really just.
I mean, I think that's a big part of why I think and there could be a lot of catalysts, right? I mean, I think AI is a perfect narrative and catalyst for why, because the opportunity is there and it's going to be there for a long time. And there's a lot of other catalysts in the stock market for why it's doing what it's doing. But I also think a big part of why the stock market is doing so well at the same time is because of all of those tailwinds.
Yeah.
Your best risk reward ratio is going to be in the stock market right now. Like the cost of capital.
Even though the volatility is still kind of the price you're paying in the short term.
Totally. I mean, compared to, it's hard making real estate deals pencil. I mean, I was sharing this on my ex earlier. Like for the cost of debt right now and the cost of capital, and rising insurance and rising construction costs and plateauing rents and maybe little cracks in the economy that people are concerned about, the amount of energy and effort that goes into owning and operating real estate versus the margins that are left over for that, people are going, I don't know if I want to take those risks and have to jump through all of those hoops in order to get that at the end versus, I see what's happening over with NVIDIA right now. I see what's happening over with SpaceX right now. I see what's happening in the stock market. I see what's happening in just the boring indexes and not having to do a damn thing. And I'm still clipping a nice return compared to what I'm going to get in real estate, right? So I think it's a perfect storm for why the stock market is doing so well. And that's just maybe one catalyst. And to your point, if and when we do get some of the, rate cuts and some of that pressure that comes off of real estate and the other asset classes, we might see a rotation out of that. I don't think real estate is there yet. There's still a lot that I think needs to play out for real estate to be there. And I'll kind of share my thoughts on that here in a little bit. But we are paying attention to this week's events. We got June S&P Global PMI data, May new home sales data. We got PCE inflation data. Really, that seems to be the biggest one this week. Really, any inflation data prints, I think, are important.
They're holding extra weight right now, but PCE is important because PCE is typically an indicator that CPI or producer cost index prices will pass through to CPI, because if producer costs go up, consumer costs tend to follow cyclically. That's not always been the case, but that's typically the case. So that's why the PCE reports will be extremely important. Now, if we get beats on those, it's just as important as if we get misses.
Yeah. Now, Bank of America came out today and said that they expect the Federal Reserve to raise interest rates 3 times in 2026. I mean, that's pretty aggressive. First off,
yes,
I don't think that's going to be true. I'm curious on what your thoughts are. We did see rate cut increases and the probabilities jump post Warsh meeting. So are we going to see rate? I mean, you and I were having this conversation, but are we going to see rate increases this year, or are they going to hold through the remainder of the year and really? And again, I think a lot of this comes back to how this Iran conflict plays out.
Assuming things continue to trend the way that they are, which I still think is to the positive with the conflict, I don't think there's enough data right now to cut, but I also think that we equally don't have enough data to raise interest rates, right? Everybody talks about, hey, we need to raise interest rates and stuff, but they're doing that when oil prices are trading at $90 to $100 a barrel. Now we're back to 72, 73. That's already starting to play out at the pump. So Americans are going to start agreeing with that. Consumer sentiment's going to settle. So I think that idea that I pushed to you, where I said when the U.S. floods the global market with cheap oil, and they will, that's going to moderately bring inflation data down over time. And if everything else can come into line with that, that would create a perfect storm to where we'd have volatility until traders felt like we were trending down enough or in the right direction, and then we would see a very quick pop. That's my anticipation of what's going to happen. So for people that are long-term investors or putting their money into the market, like a lot of my clients are, they always look for opportunities to, buy the dip or get in things when prices are low. We were buying stuff at the 67, 68 range, and we're in 73 right now. So it's probably a good time to buy that because nobody was mad on 68 to 75 or 76 almost. People shouldn't be disenfranchised on seeing the 74, 73 number on the S&P because we're probably going to break through that maybe before year end and probably by sometime early next year, and we'll continue to chug through that. So it's just an opportunity indicator to me most of the time, but it's not going to be as long as I think people are anticipating. When it happens, it'll be like a Band-Aid on a leg. It'll be quick. It'll kind of hurt a bit, but it'll pass quickly and people will soon forget about it.
Well, I saw Wells Fargo Investment Institute set its 2027 year-end S&P 500 target range at 8,600 to 8,800.
Holy snap.
Yeah, I thought that was aggressive, but I mean, that's obviously,
JP Morgan's
a year and a
pretty
half
bullish
away.
as well. I mean, JP Morgan's been very bullish on their outlook for 2026 as well.
Jamie Dimon kind of said we're in a bullish tsunami right now. Barclays said its S&P 500 target is now 8,800 in 2027. So if there is short-term volatility and we're talking about maybe some of these, small corrections or pullbacks, what you're saying, what you're seeing, what these institutions and smart capital are saying is they still see, obviously, in between now and let's say the end of next year, this target is a lot higher than where we're at right now. I mean,
Yes.
Tone, you can pull it up on the screen, but I mean, as of today, we're at what, 73.65 at the close. We're down 144 basis points today. So we did see a little bit of a correction.
Yep.
But overall, I mean, from 7,300 to 8,800, that's still buy the dips.
That's over
long-term type of market mindset, right?
Yeah, it's over 10% return. Plus, dividends over that period of time. That would include overperformance by some individual names and underperformance by others. But yeah, it's not hard to make money in stocks. You just have to be in them for a while and buy quality. My job and most of the relationships that I have with my clients is just making sure they don't make bad emotional decisions and then picking the investments for them, which is what we're paid to do. So the short-term volatility, again, I try to teach my clients, is just an indicator of opportunity if what we're buying is something we believe in and we believe in the stuff that we buy.
Yep. Hey, what's up, guys? I'm so excited to announce if you are an investor looking to generate consistent passive income, then I've got something for you. I just launched the Imagos Income Fund. It is a private investment debt fund. So instead of relying on long-term appreciation or big exit events like most real estate syndications do, we decided to keep it simple, focused on first position asset-backed lending just like a bank, meaning your investment is backed by real collateral and structured to produce income from day one. The target return, 10% paid out annually and also paid out monthly. So no guesswork, real passive returns, true mailbox money. And because we're in the debt position, not equity, we're able to prioritize downside protection, maintain shorter durations, and stay in control of the risk, which is most important in environments like this. This is built for investors who want steady cash flow, strong capital preservation, and real asset exposure without the headaches of owning, managing, and waiting years for a payoff. So if this resonates with you, if you want to learn more, I put together a full investor presentation breaking everything down. All you got to do is just text the word income to 844-447-1555. That's income to 844-447-1555. I'll send you everything so you can see if it's a fit for your portfolio. All right, so maybe this will tie back into one of our new segments for you guys. So maybe you guys can play along with us on this particular segment, bullish or bearish. And I'm going to give you, let me set the table here. Maybe you can choose, but let's just say bullish or bearish time frame is over the next 12 months. But you can also say like, hey, long term, I'm really, bullish or bearish on one of these particular ones. So we'll just pick some of the big ones that have kind of been in the news lately. Headline that I saw this morning was NVIDIA announced they have a warm water cooling system that it says can dramatically reduce the amount of water a data center uses, eliminating pretty much all water usage inside the data center. Now, this is obviously, been something that has been a concern around CapEx and development and the usage and resources for AI, NVIDIA, their chips, and obviously being the leader in that space. Tone, you can pull this up on the screen today. We saw NVIDIA with a pretty healthy little pullback, 4.13%. Are you bearish or bullish on NVIDIA?
Definitely bullish. It's one of my favorite AI plays because it's got AI, tech, semiconductor, all sorts of good stuff. So still bullish on NVIDIA. The 200 mark is a good entry point for investors. I see it after hours as being eaten up a little bit. That's going to be mostly institutions. So still very bullish on NVIDIA.
All right. Now, the one that has really sucked up all the headlines over the last week.
SpaceX.
So
Called it.
let's see. Let me pull this up, Tone. SpaceX, as of today, we actually saw a little pullback earlier in the day. Got bought back up. But I think, based on what I saw earlier, it's down around 16% from its peak and is trading right where it was at or a little bit above where it was at when it opened. So, I mean, this goes back to what we were talking about of, unless you're a highly skilled trader and you're, very, very much engaged and invested in these types of companies, this was not one that you want to buy right out of the gate. Like, based on the lockup periods, and I wish I would have had that up there because it kind of shows all the different lockup periods and how much gets released and all that kind of stuff, which will, I think, tie into supply and people taking some profits off the table. You talked about maybe letting it settle for 6 to 12 months, depending on where those lockup periods are. Are you bullish or bearish on SpaceX?
Short term, I'm bearish because I think the price is going to be under pressure until the 12-month lockup period. Most of the major investors, including Elon, have a 12-month holding period on that. So you'll see some profit taking at that time. That'll drive the stock price down pretty wildly, like we saw in Palantir, like we've seen in many other IPO names that are now very successful. And so the entry point tends to be after that period. You can still get all the pre-IPO kind of enthusiasm with the ride up, but you don't have to deal with the ride down. So long term, bullish. Just in the short term, probably bearish on that.
Okay. All right. So today we saw Meta just announced that they're building their own prediction market app, which, don't get me started on prediction markets. I think
It's a sexy way to say gambling.
While they have very interesting cues and insights into social culture and trends and kind of probabilities playing out. To your point, I think gambling is becoming a massive, massive problem for a lot of people, specifically young men. Younger generations. I don't see a lot of young ladies sending it. I could be wrong there, but just in general, I mean, when you look at the amount of money that is being made by Polymarket and Kalshi, and now you've got pretty much any type of investment or gambling platform has significantly expanded their reach in this particular space. I think it's a slippery slope for a lot of people that don't have the discipline or the education or insights around it. That's going to lead to some pretty bad stuff. That being said, if there's money to be made, companies and capitalists are going to go and find out how they get their fair share of it too. And Meta said they're building their prediction market app. Per the New York Times, Meta CEO has a small team building a betting app to take on Polymarket and Kalshi. They did decline to comment, but inside Meta, the project is called Arena. And it is something that, as of today, where did the stock go there? I think it bumped a little bit today. But in the short term, or maybe long term, Meta, I know we've held it, we've gotten rid of it, we've held it, we've gotten rid of it in our portfolios. Are you bullish or bearish on Meta?
Bullish. Yeah, they're just the penetration they have to get information to their market is huge, and a lot of the baby boomer generation, the one that has the most money right now, is on that platform. So very bullish on that.
Okay. We talked a little bit about IRL. And
IRL streaming.
And this was one that, again, isn't representative of IRL and the whole marketplace. But it is one that obviously is a big leader, and in my opinion has been really doing a good job. I mean, we just went and saw Toy Story 5 with the girls, and they freaking loved it. And I don't know, there's just like a vibe when you get in a movie theater, you go to a concert, or you go do something in real life, and you get these real life experiences. Like, it just, for me personally, it's something that I get super charged up by. If there's something I'm going to spend a shitload of money on, it's in real life experiences. I know that's something you and I love doing, whether it's us getting out to Napa and doing, 5-star experiences. It's us, traveling and going all over, the world. It's doing things with friends and family, staying in nice, whatever it is, right? Like, if I'm going to spend money, I want to spend it on real life experiences. That's something that I love to do. AMC Entertainment, as of today, their shares are down 17% after the company announced pricing of a $200 million stock offering. I thought this was kind of funny. I follow this guy, Thread Guy. Shout out to him and his team and all the cool content that they put out, mainly in the crypto space, but investing and other things like that. But you can pull it up on the screen. He was like, "You absolute idiots! Movies are hot for the first time this decade. There's genuine buzz about doing things in real life. AMC was up 50% this month for the first time since COVID. Toy Story with its biggest opening in franchise history. Christopher Nolan, The Odyssey this month. New Timmy movie announced. YouTuber producers getting extreme buzz. Google just made a big investment in A24, which is a production house doing movies. All kinds of cool stuff happening in real life. One, what are your thoughts on AMC and this pullback? Was it due because of how much they were up? Is this healthy? Is this representative of something bigger? And maybe you can just say AMC, bullish or bearish, and IRL as the category, bullish or bearish.
I would be IRL bullish, and I would say AMC bullish as well. I think that up 50%, there's obviously going to be profit takers in the short term, but I enjoy going to the movies. I think it gives that kind of experience and getting out of the house. And we have a studio movie grill near us, which is kind of fun for adults because it kind of have the restaurant bar, and then you can order food from a waitress or waiter while you're watching the movie. It's pretty fun. So yeah, I'm very bullish on it, and I think they kind of have this cult following. Them and GameStop kind of have that about them. People like them because they were the Robin Hood, not the company, kind of like the old Robin Hood with the bow and arrow type deal.
Yeah.
Taken from the rich and given to the poor, but really just they allowed people to get wealthy in their stock at a low price. They held through all the volatility, all the short squeezes. A lot of the short sellers that did get involved with those companies are now been found guilty of insider trading and other fraudulent items. So I think it's a good story. I don't think they're going anywhere.
All right, let's wrap it up on a few more. As a main topic, are you bullish or bearish on the U.S. economy?
Bullish.
Are you bullish or bearish on the global economy?
Bearish.
Bearish. Okay, so just give me a quick little tease out of why you're bullish on the U.S. economy, but you're bearish on the global economy.
I just think that because most retail investors would say the opposite, so that's another reason.
That's an inverse
indicator that probably a good idea to not invest non-domestically. But historically, domestic equities have always outperformed developing or developed markets. I think people are chasing like outperformance in short periods of time, so cherry picking times that the emerging markets have done well. But to me, I just don't see the global market ever competing or keeping up with the U.S. market. It's kind of just like everybody it's kind of like Tesla, right? I don't ever see Tesla not being one of the number one names in electric cars, even with all the competitors. So the same thing would go for the U.S. stock market. We're kind of the Tesla.
Yeah, I mean, that's a good point, right? I mean, Tesla, their market cap is larger than the next 12 or 15 car companies combined, something like that, right? And that's kind of how the U.S. economy is as well. And also what we talked about on, while energy prices are impacting us, they're significantly impacting the global economy more than they are the U.S. economy.
Yeah, correct. Because we're used to paying higher gas prices because of our taxes.
So the pain that the U.S. economy may be feeling in the short term or the midterm, you can expect that to be much more exponential for the global economy and how they absorb it and the impacts that'll have. Okay, makes sense.
Yep.
All right, oil. We talked about this a little bit earlier. And I'll just give you a little bit of data here. So hedge funds are aggressively betting on lower oil prices. Hedge fund net short bets on Brent crude oil are up to 18 billion, the highest in the last 10 years. This figure has more than tripled over the last 3 months. This comes as hedge funds and institutional investors sold 7.5 billion of Brent crude oil in the week ending June 16th, the largest weekly sale since April of 2025. New short positions accounted for 80% of total sales during the week, meaning most of the sales came from fresh bearish bets rather than the unwinding of existing long positions. This also marks the 7th consecutive weekly sale totaling 24.8 billion. So usually when smart money is an institutional capital is stacking that heavily on a bet, to me it tells me they know something. They obviously are very convicted in what they believe is going to play out. They think this conflict is going to wind down, that oil is going to continue to drop. Is the short oil trade becoming too crowded, or are you bearish on oil and it continuing to trend downwards?
Yeah, bearish on oil. I think it'll go to the mid 60s.
That's your bet?
Yeah.
Time frame?
3 months.
Okay. Yeah. All right. Last one. Amazon. So
Prime Days in 3 days.
yeah, and this I think this kind of ties into not the last one, the second to last one, Amazon's second to last one. This ties into an industry that I think is still very new. Is somewhat small relative to where I think it's going to be in the long term. But Amazon, what are your thoughts? Bullish, bearish? Why?
Bullish, just because again, I think the majority of U.S. consumers have an Amazon account that they're paying a membership for, and they buy multiple things. I was just making a joke. Hopefully, my wife doesn't watch this episode or isn't watching now. Love you, honey. But my phone is just lighting up right
Just
here.
lighting Amazon.
Amazon. I'm just like, there we go. So yeah, I'm. That is my indicator. That's my bullish indicator. Amazon. Thanks, babe.
Well, my buddy sent me a video the other day with the drone. He was sitting out in his backyard. He's smoking a cigar. He showed me a screenshot of something that he ordered off of Amazon, no shit, 30 minutes prior. And it was freaking getting drone dropped off on a string, into his backyard onto the grass.
Yep.
And so part of where we'll wrap up this bullish bearish segment is I think robotics and the technology advancements that are happening in our robotics, companies like an Amazon, companies like a Walmart, there's a lot of companies that are going to benefit from advanced robotics.
I think we will benefit. The majority of the benefit's going to be to humans.
For sure.
Because it can be we can build infrastructure with them because they'll work 24 hours a day, do things that humans can't do, no risk to injury. Yeah, I think that what the world will look like in 2045, 2050, because we should have robotics and humanoid robots moving around by then and doing stuff, is going to be a lot different than what it looks like today.
Well, and we'll just listen to this segment. There's a couple segments on robotics that we'll do a quick little soundbite on, but the amount of productivity, the amount of labor savings, all of that is going to drop to the bottom line of these shareholders, and shareholders benefiting of these companies, right? And so this is Jensen Huang of NVIDIA talking about his outlook on robotics. Let's give it a listen.
Ultimately, one for one, Elon seems to think we're going to have one robot for every human, 7 billion for 7 billion, 8 billion for 8 billion.
Well, I'm hoping more. Yeah. I'm hoping more. Yeah. Well, first of all, there's a whole bunch of robots that are going to be in factories working around the clock. There's going to be a whole bunch of robots that don't move. They move a little bit. Almost everything will be robotic. I mean, just the simple math at the moment is we're millions of people short in labor today.
Right.
Yeah. Right. We're actually really desperate in need of robotics. And so that all of these companies could grow more if they had more labor. I mean, we're number one. Some of the things that you mentioned are super fun. I mean, because of robots, we'll have virtual presence. I'll be able to go into the robot of my house and virtually operate it. I'm on a business trip.
Right.
Walk around the house.
Walk the dog.
Yeah, walk the dog.
Rake the leaves.
That's crazy.
Exactly. Freak out the dog. Maybe not quite that, but just wander around.
Yeah.
And just see what's going on in the house. Chat with the dog, chat with the kids. Yeah.
Ultimately,
that's one of the most connected, smartest dudes on planet Earth right now.
Well, they're making the chips for him.
Affirming Elon's vision and what he believes, could be even more grand than that. I've been following this dude too. This is a young cat that was like a crypto guy, and he bought into a robotics company and decided to shift his whole kind of brand and career and focus out of crypto into robotics. And he was on a show called The Market Bubble, two crypto guys that interview a lot of cool people. And here was his take on robotics. And I'm sharing this because I do think that this is one of those industries and markets I'm very bullish on long term. I don't know how quick it's going to get here. I still think it's very early. But he gives a little bit of insight, Andrew Kang, on his thoughts around where robotics are heading and how quickly it may show up. But definitely something to be paying attention to.
If you had to bet on a year that we can look outside and see robot police, robot PAs, robot maids, construction workers, and the world has changed in that way, and it's just normal. What year do you think this is? How far out do you think we are from that being reality?
I think you're going to get like humanoids that are almost as good as like a regular human in 2 years. Like, I think you're going to get to like Opus 4.8 level there. Then I think there's going to be a bottleneck with hardware though. Right? Like we can't spin up a million instances of like robots like we can instantaneously with AI, like chatbots. And so like that manufacturing is going to take a long time to scale. Not a long time, but it's not going to happen in 2 years. Maybe we're making 100,000 robots, or maybe we're making, like millions of robots in 2 years, but like that's not enough to fill the needs of the entire world. If we're like, if we're talking about billions of robots, that's probably like 2030 plus, early 2030s.
So within the next decade, maybe, right?
Yeah, that's what I think. That's what I said. 2035, 2045, somewhere in that window is when it's really going to blow up. I think the application is going to be more towards infrastructure to, building huge cities really fast, building roads and keeping them up to speed really fast and efficiently. And cost will go down, and that means less tax dollars going to those. And maybe they could go, same dollar spent can now be spread out more efficiently. So that's where I see robotics really helping.
Yeah, when you really tease out the benefits to humanity of robotics, and you can get past kind of the iRobot, they're going to take over the world and make us their slaves kind of thing.
Yep.
I just see so many net positives for investors, for humans. I mean, just on so many different verticals that I'm personally really excited to see where it's going to go. And I'll end on this one because I thought this is pretty wild to hear where robotics can even play into the arenas of entertainment.
They're basically trying to create the UFC/F1 of robotics. And that's right. Like, that's so much fun. Like, you can have these robots fight in the same way they did in like gladiator battles, whenever they did those. And like, that was the biggest entertainment at that time. We can't have gladiator battles anymore because it's like you can't have humans killing each other for fun.
What was that one show? It was like Bot Wars. There was a show like that where like little robots Yeah, BattleBots. That show was epic. It was like Spike TV or whatever. It was like one of those channels. That's awesome.
That was actually
Example of them fighting, like
Yeah.
Dana White starting some sort of competitive robot fighting league.
That's
Where
how
like
it's
these robots are fucking built with, the latest and greatest tech. They're worth fucking, $10 million, and they're fighting. There's real stakes on the line, and people are fucking excited. And obviously, people trading markets on the competition aspect of it. I don't know. It's fucking cool.
So, I mean, it's kind of like that's one of those extreme.
I loved watching BattleBots.
That was the shit
dude.
back in the day, right?
Yeah.
But I mean,
which one's gonna win? It was the original like kid boxing.
Yeah. So I just think robotics, I'm very bullish on it. I'm paying
Same.
attention to it. He even, and we'll wrap it up on, on robotics on this topic. He even mentioned though, like pre-IPOs and really like private investment companies and private funds and VCs, like not a lot of people are going to get to see or touch any of these companies for quite some time because that market is become so robust. I mean, we saw it with SpaceX, right? Like retail didn't get a fair share of that. You had to have private access into that world to really like get the benefits of it. Now you might get it long-term macro, right? But like getting some of that early alpha, you have to have the right relationships. You got to be connected into the right circles with the right companies, because if you don't, then you really miss out on some of that really early stage alpha that I think early industries like this can really create some exponential growth and gains for people.
Correct. That's why, people talk about Apple and Nvidia and stuff. It's because the money they made in those companies, and Tesla, the money they made in those companies by being earlier investors. I got exposure to it with ETFs for our clients, but we don't own any of it individually.
Yeah. All right. So just shifting over to crypto. Really, the market pulled back a little bit on crypto after the Warsh speech. I think obviously the reality is setting in a little bit that, the hopes of liquidity and this rotation out of stocks was going to come back into, the undervalued and depressed assets of crypto, which, don't get me wrong, still is potentially on the table, as we do have, I think the big catalyst for that narrative playing out is the Clarity Act. And the U.S. House Committee scheduled the Crypto Clarity Act hearing for July 17th. So this July 4th, it's going to be on Trump's desk. He's going to be signing it in. I just don't think that's reality. It's just not going to happen.
Nope.
Maybe by the end of the year?
Maybe. Yeah. If the public hearing for it on the 17th goes well, yeah.
And what could we see in the crypto markets as a result of that Clarity Act getting passed, theoretically?
I would assume we would see a very big liquidity
injection
into the crypto space as a whole, with some of the bigger names leading the charge, such as Bitcoin, Ethereum, Solana, Ripple, or XRP, excuse me, things like that. Yeah, I could definitely see them being a benefactor of that. I don't know how they wouldn't be. How much will it run up? I don't know.
How big is the stock market cap?
Oh boy. Let me double check, but it's multiple trillions.
Stock,
U.S. stock market.
I want to know this too. 137 trillion to 154 trillion is what it says. So obviously that's a little bit of a gap, but that's the global market cap, by the way.
I would say the U.S. stock market's about 75 trillion.
Yeah, so it says around 75.1. Okay, so I mean, if you pull this up on the screen, Tone, so we got the total crypto market cap is 2.14 trillion.
Mm-hmm.
So I mean, a fraction of what the stock market is, and a big part of that is because of governance and rules and laws and regulations and scams and, all the things that has really, one, created exciting opportunity for, people in crypto, but also a lot of destruction and, a lot of downside for a lot of people as well, right? And so until that Crypto Clarity Act gets passed, I'd be very interested to see, I mean, if we come back and look at this video, if and when it does, and maybe a short window of time after it does get passed, where we see that market cap jump to. I mean, is it a couple trillion? Is it tens of trillion? I don't know. What would you say? I mean, it's kind of a tough thing to even plan or think for, but I can see it jumping a couple trillion.
I would say that you would probably see it triple or quadruple.
Okay.
In the early years, and then that would be mass adoption, and then you would see it continuously grow from there.
Yeah.
But it'll take a long time to get close to where the stock market is, just because how much bigger it is than that, and how long it takes to get $1 trillion. It's not just a small number.
Yeah. So, all right. So as we wrap up a little bit of real estate, man, y'all know I wish I had something exciting to talk to you about with real estate. I mean, the real estate market is the real estate market. It's stale. It's challenging economically. If you're an investor, getting numbers to pencil at scale right now is tough. I mean, of course, there's always going to be opportunistic, one-off opportunities. And those are the ones that you should be hunting for in this particular market, by the way, because, just like stocks and crypto, the best time to buy is before the big move happens. You can make money after, of course, right? When there's run-ups, and I think we're in one of those right now. But the best time to buy stocks and crypto is before those things happen, right? It's when fear's at an all-time high. It's when demand is stale. It's when things are dormant. They feel dead. It's kind of like that depression almost. Well, real estate is no different. Real estate, the best deals are not bought after the big rate cuts happen. They're not bought after the cap rates compress. They're not bought after all the rents start spiking.
It's before then.
It's before then, right? Which is really right now. It is that time where it's right now. And I do think that, there is a lot of smart money positioning right now, buying quality assets in quality markets, quality locations. And if you look at, this real estate cycle, because every asset class has, a cycle that it goes through, right? And so this is, and I made a post on this on my X and my Facebook. But this framework is called the Mueller real estate cycle, and it goes in 4 phases, right? Just like the crypto has a market cycle, just like the stock market has a market cycle, just like our global and domestic economy have market cycles. Real estate goes through the same thing. And right now, it is not, let's just say, the expansion phase of real estate. It's a very challenging time for real estate. And again, every asset class can be at different phases of the cycle as well. A certain market can be at a certain phase of the cycle as well, or those things simultaneously happening together. Right now, hypersupply and recession, one asset class that falls into that everybody can agree on is office, right?
Yeah.
I mean, it's one of those things where,
or mega, what's it called? Like malls, mega.
Yeah, the power centers, mega malls.
They're just called mega malls or mega.
You just have your big malls that, depending on the, retail makeup of those assets, like those are going through some challenges right now. Retail has actually been one of the strongest performing asset classes.
I've seen a lot of the malls flip into indoor playgrounds.
There's all kinds of repurposing going on, right? But we have over $1.5 trillion in commercial real estate debt maturing into rates double what owners originally underwrote. We've got transaction volume down over 50% from the peak. We've got deals are tougher to make pencil based on what we talked about earlier for the risk reward that most people desire. And we got the stock market that's just ripping right now, sucking up a lot of that liquidity and demand. People are going on. I'd rather not, click a few buttons and just be patient and let the market do what it's going to do instead of having to take on all the stress and the risk of real estate right now.
Yep. Spread there.
But like I mentioned, right, when we get back into this recovery phase in certain asset classes and we get back into expansion mode, which a lot of that is going to be dictated by rates. It just is. That's when it's going to get exciting. But you do want to try and pick up assets, in phase 3 and phase 4 of this market cycle. If you can make the deals penciled today, all the people that I know bought stuff in 09, 10, 11, 12, when it was hard to buy it. It wasn't sexy to buy it. Prices were way down. Rents were way down.
Thought you were dumb.
All of it.
Yeah.
And then it's the people I was one of those people where like, fortunately, I just got lucky. I was buying single family rentals for like 75, 100, 150 in Sacramento. Like those numbers are unheard of in California now.
Yeah.
I sold some of my rentals pre-COVID when I was going more into commercial real estate that I picked up for 75 for like 400. Now they're like 650, 750. I'm like, I should have held on to those, right?
Yeah.
But
Coulda, woulda.
looking back, that was the hardest time to buy. And yet I wish I would have bought more. And I think we're in one of those seasons right now in real estate as well. So something to be thinking about. If you can make the numbers pencil today, you can weather the storm and you can ride this out. When rates drop, it's going to be, you're going to be looking like a genius. And I saw this little soundbite from Kevin or Kevin Pathrath or whatever. He was talking about this may be one of the best decades to buy real estate. Here's why. Let's give it a listen.
Be the best decade ever to buy real estate. Between 2022 and 2032, we're going to likely continue experiencing the highest interest rates that we've seen since the 70s, which means real estate will continue to be unpopular unless you have a lot of cash. We believe that by 2032, we might look like Europe. It becomes socialist, and then all of a sudden wages go down for the average person, productivity goes down, and interest rates end up going negative on savings. And the people who have acquired the most real estate between 2022 and 2032 will have the biggest piggy bank and say, I now get to refinance all of this at 1.7%. This is going.
Okay, now I'm not going to go as extreme as saying the U.S. is going to be a socialist country and we're going to be like Japan and negative interest rates.
Yeah.
But
6 years.
But I do believe, yeah, that'd have been a fast unwind. What I will say is I do believe that we're going to have cheaper interest rates at some point in the future than what we have right now.
Here's the thing about most investors right now. They're consuming a ton of content, but they're not actually more informed. They're reading all the headlines, they're watching the tickers, they're following all the noise that mainstream media wants you to follow. And at the end of the day, you're still not informed on what it actually means for your deals, for your portfolio, or for your next move. So if you're listening to this right now, I don't think that's you. I think that you actually want to understand what's happening, how it impacts your investments, what you should be doing going forward, what you shouldn't be, and not just reading about it. That's why I decided to build the Wealth Intelligence Brief, a newsletter sent to you 3 times a week directly to your inbox where we cut through the noise. We send you the macro data, the real estate intel, crypto signals, and all the unfiltered takes in 5 minutes or less for free. Eliminate the noise, keep the edge. Sign up by texting the word WIB to 844-447-1555. That's WIB to 844-447-1555.
Yeah. How much cheaper is the debate?
That's the debate. And yet I know that if you can buy quality assets in this market and weather that storm as long as you need to, and again, this is where conservative underwriting, building in buffers and safety nets and not doing all the rosy pro forma bullshit that things are going to be better and better and better, like many people did who are caught and trapped right now, that bought in 21 to at the end of this, before rates rose. I think that there's massive opportunity to really generate some real wealth in real estate. It's not having its day right now, but I can promise you this, it will have its day at some point in the future. I hope it's sooner than later, but that's obviously something that we track the data on. We listen to the data and the data drives our decision making, and that's where we position accordingly to protect capital, protect our assets, protect downside risk. And at the same time, right, we use those cues and data to create conviction in a short-term, midterm, and long-term strategy with what we're doing. So as we wrap up today, I wanted to get your thoughts on this final take from 2 videos, because I think it made me think of, I'm good on when I have a clear target and I know what I want to focus on, where I want to get to, when I need to get there by, and then I can just kind of reverse engineer a strategy and I'll get to work. I'll just go and, tackle and block, execute on the X's and O's. And Kevin O'Leary had a hot take that he said the only number that buys you freedom is $5 million. here was his logic. Let's give it a listen. I want to hear what your take is after we listen to what he has to say.
A bank to be secure for the rest of your life is $5 million. And I tell every entrepreneur that go well past that, the discipline is get 5 million and put it in T-bills and just look at it. It's just sitting there and don't touch it. Because if poo-poo hits the fan, you're still good.
What are T-bills in case people don't know?
Treasury bills, U.S. Treasury bills. You can also buy gold, but it doesn't have any yield. I have T-bills. I roll a bunch of T-bills. That's my Q account. And it always has been. I've never touched it. And, I buy dinner with the interest.
So you agree with that? It's 5 mil, kind of that number that I know you've talked about it for a lot of people of like, you can live off a couple $100,000 and still have a very great lifestyle.
Yeah, that's $250,000 a year of passive income you can generate off that. Plus the account will grow at a clip of 5 to 7% per year, assuming 2.5% average inflation. So yeah, I mean, I'd be able to get that person, 16, 17 grand plus a month, every month, easy, and increase the distributions every single year while still growing the account. I have accounts that are that big and bigger than that, so I'm doing it.
Yeah.
So yeah, to me, it just depends. Is that amount of money going to, make you good? I think to his point, he was saying when you make it, you throw 5 million of your made it money into this account. Just don't risk it on a bunch of stuff. Put it into safe and just watch it grow by 3 to 4% a year. Because when you make 3% of, 5 million, that's 150 grand. You can probably buy dinner with the interest, right?
Yeah.
So,
well, there you go. Okay. All right, guys. First stream in the books. Hope you guys enjoyed it. We are going to continue improving this process. Would love any of your guys' feedback. Of course, we always love connecting with you guys too. So that was fun. I enjoyed it. What'd you think, Reidwell? You like the setup that we got in here?
Yeah, it would be fun. I'm going to be excited when we get some more bodies on here so we can get some interaction. But it'll be good to talk to you guys live.
Yeah.
It'll be real fun.
Yep. So we're going to be doing, I guess we need to kind of figure out our schedule so that way people know when to show up. And this is a little bit of an impromptu one. But if you guys want to connect with Ryan and his amazing team, as always, text the word X-ray. You can see it there on the screen to 844-447-1555. Ryan will talk until he's blue in the face on stocks, investing, your portfolio. And one of the great things that they do is they'll do a complete mock-up of a portfolio of how they think would be more aligned with your goals than maybe what you're currently doing. And also, I know the most important thing that I enjoyed was seeing all the fees that I didn't necessarily know I was paying. So you can text the word X-ray 844-447-1555 for all my passive investors that are interested in getting more mailbox money. If you're income focused and you want to generate income, we have the Imagos Income Fund. It's basically a hard money fund, right? Where we make loans on collateralized assets, first position. We get paid monthly. And guess what? So do you. So if that's of interest to you, you can text the word income, partner with us, and become in the bank, 844-447-1555. One of the things that I found was really good for that strategy, which one of our mutual friends, one of your clients, one of the investors in the fund, shout out to Paulie Shack, pulling out of his life insurance. Like, really cool thing of you've got, your life insurance that's built up some cash value. Obviously, God forbid something happens to you, you still got that policy in place, but you got this bank account that you've built up that you can actually pull on. Yep. At, say, what is 6% around right now?
I think the rate is right at 5, but there's no underwriting, and that policy is making about 8% right now. So he's pulling about a 3% positive arbitrage on the loan cost. So earning interest on the money while it's being lent out, no underwriting, no taxes. It's pretty nice.
Yeah. So he's rolling that over into the fund and I'm paying him 10%.
Yep. So it's like double dipping.
So he's getting a nice, so like if you do have a life insurance policy,
verticals on $1,
and that's something that, is of interest to you, that's where I think probably one of the sweetest and sexiest parts of the life insurance arbitrage model, that you still get all the benefits that you wanted originally for it. But now once you build up that value over time, you can start putting it to work. And like you said, getting a little double dip there. So that's of interest to you. Text the word income, 844-447-1555. As always, we appreciate you guys. Keep investing in yourself and your wealth on your march to $1 million and beyond. We'll see you guys next week or next episode. Cheers.
Cheers.